Hello traders, this is Dollar Will. Before I get started, I'd like to remind everyone that everything I say in this video is my opinion. I am not a professional. I do not have a license to give advice. So please consult a registered investment advisor, a chartered market technician. You can find these people at your bank or wherever your money is held. So take everything I say as my opinion. I encourage everyone to study for themselves, but in times like this, I recommend that people also use the resources that are available to them at their bank. Okay, that out of the way. It's my opinion of what's going on in the market. If you have not seen my video that I did on January 13th, stop here and go watch that video and catch up. All right. The market is tanking. We know that. But where is the money going? In the middle of all the panic, we have to keep in mind that not everyone is losing. Someone is winning, or some people are winning. Okay. I was watching CNBC, and they're telling people to hold their position. Don't panic. They're saying, no, I don't think anyone should panic. Definitely don't panic. But whether to hold your position or not, that's, in my opinion, that's idiotic advice. The only reason to hold the stock is if you think it's going higher. To tell people to while the market is tanking, not just the American stock market, the global stock market is tanking. All industries essentially, in all countries essentially. To tell people to just hold on and be positive, why would you tell people that? There's only one reason to tell people that. This may sound, look, this is just what it is. When you hold on to your stock, it allows big money, rich folk, to sell their stock. When you don't have but a little bit of money, you can get out of the market faster than they can. But if you get out of the market, the price will drop faster and it'll lower their exit price and they will lose money. So you are told to hold on to your position. Just ask yourself, who owns these stations? It's rich people. Okay, so maybe that's too pessimistic for you, but why else would TV tell poor people to just hold on? Fundamental traders are told, if you like the fundamental story, the reason you bought the stock, if the story is still true, if the fundamental reason you bought the stock is still true, then you should keep holding the stock. That's insane. That's insane. I remember when I used to be a fundamental trader. That insanity is what drove me completely to the technical side. Now, as I said in other videos, I am a technical trader. I am an extremist. I do not care about the fundamentals. But I also generally don't buy individual stocks. I buy sectors or industries. I buy whole industries, baskets of stocks via ETFs. So I pick industries. I'm Dollar Will. I pick industries that are sensitive to the movement of the US dollar. And so I'll buy oil. It'll be a basket of oil companies. It'll be a basket of gold or metal, precious metal ETFs. Okay? So that's how I roll. So what I want to do right now is step you through what's going on in the market. What we're looking at here, this first page, is my favorite site is barchart.com. It should become your favorite site. I tried to become an affiliate. I said, now wait a minute, if I want to tell everybody to use this page, I should get some money from it. They don't have an affiliate link. If you ever see me, and I will have affiliate links for some things that I recommend. If you see an affiliate link on my page, it's because I really believe in it, and I really believe in that site, and I really actually use it. Okay, so and if I'm doing promotion for them, I should get some money. So there's my capitalistic plug on that. All right, today on New York Stock Exchange, it shows kind of 50-50, almost. We got 54% advancing, 2% the same as, of yesterday, 884 declining. All right. You can kind of see the same thing there too. So this is under the market pulse. So you can kind of get a glance at what's going on. I'm just going to step you through some pages real quick. We're going to drill down further to like where the money is in times like this. Under market performance, they have this map. We call these a heat map. Show you where the money is. So you got the 5-day moving average, you got your 20-day, which is really like a month, and then this 50-day is like 2.5 months, and the 20 with 20 trading days in a month divided by 5, that would be 100-day moving average would be like 5 months, and on and on. You can kind of figure it out. So as time goes on, all of these columns are going to be red, including the 200-day. The 200-day moving average is like 10 months. They're all going red. So what you see is over the last month or last 2.5 months here, it's showing you that they aren't negative yet. Hold on, let me see. Actually, yeah, yeah. This red is negative. Red is negative. I'm expecting to see a negative. Let's see. No. It's percent of large cap stocks above their moving average. Okay, so that's how much above their moving average they are. They haven't gone below it yet, but they're going to go below it. This is 18%, so it really doesn't have much to go. So you're going to just see this like wave of destruction spread across this whole category, each of these moving averages, and just take them all out. All right. I'm sorry. These are the sectors of the S&P 500. This is the entire stock market, basically divided up into sectors. You got the S&P 500 index. You got your consumer discretionary. That's stuff like cars, a home, stuff you go to the mall. In short, stuff you don't need. Stuff you buy with your money that you really don't need. It's not food and shelter. So let me take homes out of it. It's items like TV sets, so things that are discretionary, things you want but not need. Now your consumer staples, that's your food, and then you got energy. We know what that is. Financials, healthcare, industrials. Those are your metal. No, what are industrials? Let's see. Let's kind of get a sense. So you can click on it, and that'll give you some idea of the companies. Okay, big industries. Okay, American Airlines, stuff like that. Boeing. So the 500 biggest industries. That's a train, a railway, a finance. So big industry. Let's see. We get back to the heat map there. Okay. And then they got a heat map here that breaks down the mid cap, the small cap. Now, what these small cap, mid cap is, that's just think of it as the size of the company in terms of how much money, not how much money they make, but what these are the large caps are the largest companies in the stock market in terms of how much money is invested in those companies as via the stock, and the small caps are the smallest, and the medium, of course, is right in between that. So So the S&P breaks it out by size of company. The thinking is that when times get tough, small companies are at greater risk because they don't have enough money. And so they usually are more volatile. They move higher, and they're also their stock price moves higher, meaning the small cap, but it also drops lower in bad times too. So people kind of feel that it's safer to be with a big company like Apple, because Apple and IBM, they're not going to go out of business. So that's why stocks are broken out by market capitalization. The theory again is that bigger is stronger. All right. Same kind of thing. Russell is another index. The same concept as the S&P 500, breaking companies up based on market cap. All right. I'm gonna move on. You got the Dow, and you got the utility company. I'm sorry, you got the Dow transportation companies and utilities. And then and the Nasdaq 100 is the largest 100 companies on the Nasdaq, largest by market cap. We're not talking about necessarily revenue. How much investor money has been attracted to it? And you took all the outstanding shares of the company and you multiplied it by the share price. That tells you the market cap. All right. Let's see. What I have here, and I recommend you do this. I go here and I click this box right here to get end of day. This is a list of all of the stocks and all of the exchanges. I have it set up to show me the advances for 10 years. Who made the most money? You can break it down by all these various choices here. But the reason why I have 10 years selected, because I want to know when the market ran up from 2009. Now we're at 2018. So that's about, what's that, 9 years? Who made the money? What companies made the money? So I clicked on advancers, 10 years. I sorted by 10-year percentage gain, and this global telecom company, GTT, went up 8,640%. Why do I want to know that? I want to know that because it's telling me, one, if I'm interested in trying to short something, that would be one place to look. I would go, of course, and look at the chart further, okay? I wouldn't just short them because they're at the top of the list, but if I'm hunting big game, I'm coming after the ones who made the money. Where did the money? It's like, why do you rob the bank? Because it's there. That's what I forgot the famous criminal that said that. But that's the thinking. Conversely, I'm sorry, that's the 10-year. I'll leave it at that. All right. Let's look at the decliners. Who did not participate in this run? This is my favorite company to watch. Right here, dry ships. Why didn't dry ships participate in the run? Dry ships is a dry bulk carrier, and I'm dollar will. And oil has been falling for all of this time that the S&P 500 has been rising. And shipping companies depend on oil. Some of them transport oil. So when oil dropped, these dry shippers were dropping too. I do not think this is the time to buy them, but that time will come. Maybe in a month, but I'm watching them. So we're at a crazy point right now in the market where essentially everything is dropping. So I tried to find some industry that I could say, hey, you guys, check out this industry. I can't find one. Everything is dropping right now, but everything will not continue to drop. Those industries and companies that have been declining for the entire time that the S&P has been rising. I'm watching those companies, and the ones that have been falling the most over the last 9 years have been oil, the shipping companies, and precious metal. And all of those things suffer when the US dollar rises. So just by tracking the dollar, it keeps my attention right here. I'm going to be one of the early ones to jump on this when the time is right. Now look at this decline. I mean, this is crazy. That's how many points and change. If I told you, look, you don't even want to know what the high price of this is. I'm going to let you look it up yourself. I'm not even going to do it. DRYS. You go back and see how it's a ridiculous price. Okay. Yeah, it's pretty staggering. All right. So that's the theory there. You want to see who lost money in the last 9 years. And as this market declines, and as the dollar runs to its new high it's going to make, it's going to exceed the highest point since 2011. If you look at a chart of the dollar, you'll see that I think the high was in January 2017 or something like that. We're going to take that out. That's my opinion. And we're going to take that out. And when the dollar completes this little short-term run, maybe over the next month or two or however long it takes, I will run from the dollar like it's a house on fire. And I will be very interested in my company right here and these other shippers. These are ocean shippers that transport goods between America and Europe and China and all around the world. These are real companies here, okay? They're not going anywhere. We can't have our global economy without these shippers. These shippers transport, this one transports dry bulk goods. So we're talking textiles, grains, metals, um, yeah, dry bulk. Now, some of them transport oil and so on and so on. Anything, if you get an automobile from Germany or Japan, it's coming on a ship, okay? So everything, all these things on the label you see, made in China, made in Korea, or whatever, it came here on a ship. All right, so we know these businesses aren't going anywhere. So we got our decliners that are going to rise at some point, and we got our advancers over the 10 years that were the greatest benefactors of this rise up. And I'm just watching the way the money flows. But I don't, again, I break it out on a chart to as I get closer to what I think the bottom is. I don't just buy it because it's at the bottom. All right. I don't need to go over this. This is the Russell 3000. It's essentially, it's the big companies. We already talked about that. One of the big companies that got my attention was Live Nation. You know that company that sells the tickets. Live Nation had a very high price to earnings ratio. What price to earnings ratio is, it's a premium that people pay. People pay more for companies that, I don't even want to say that they pay more for companies that make a lot of money. They pay more for companies that are popular. Sometimes companies are paid, their price is so at a high point just on faith, just because people like it. If Facebook wasn't making money for a long time, and people thought it was going to make money, and so they charged a lot of money for the stock. The same thing happened during the internet bubble in the 90s. So I can't even say that prices they are a premium is attached to a price, making it a very expensive stock because it makes money. It's not true. For whatever reason, in people's mind, in fundamental traders' mind, they pay a higher price for the stock, and the PE ratio is they take the earnings of the company, the amount of money that the company earns, and they multiply it by the stock price, and that gives you a PE ratio. High PE ratio stocks, they have to come down in a market like this. And this one, Live Nation, if I was really into shorting stocks, I would go after this one and short it. Because with this market declining like it is, who's going to an arena? Live Nation owns, not owns, they partially own, I guess you can say. They sell tickets to a lot of arenas around the country. That's concerts and sporting events and on and on. You know, you've gotten your tickets. Ticketron is one of they merged with Ticketron. Okay, people losing money. Nobody got time to be buying no daggone tickets to no games. So you know this company ain't gonna make it. And you looks right here like we got a double top right here. I don't even have to pull it up. Now when the price drops below this neckline, this little the low between these two peaks, when the price drops below that neckline, it's really gonna pick up speed. So yeah, that's pretty much all I wanted to point out about that. That being a technical trader, you don't fall in love with no particular stock. You're trading the macroeconomic environment. And fundamental traders are told, as long as the company makes money, keep holding on to the stock. And technical traders go in and basically profit from the decline of that stock, while the fundamental traders are told to keep the faith. Yeah, right. I'm so glad I'm not a fundamental trader. Okay. This page talks about the world market, world index. We're just going to glance at it real quick. Now, this world index, this particular world index excludes the United States and Canada. If I hold on, oh, it's updating. It's updating for U.S. traded stock focused on globally. Gotcha. See, it says world markets allows American investors to find U.S. traded stock and ETF opportunities focused on global regions and countries. So these are symbols traded in America that focus on areas of the world that's not the United States and not Canada. The idea is people are told you should diversify. Okay, and part of diversification is you shouldn't have all of your money in U.S. companies. That's what they say. I don't believe that crap. Okay, it is crap because there's only one world. It's only one freaking world. And let me see, 1 month change. I don't have to go to another page. This is it. This whole index is down for the month. Keep your eye on this world index. Europe is down. Latin America will be falling. Okay, it's up for now. It's going to go down because there is there's a big oil company. God, why can't I remember the name of it? That correlates with their stock market, and oil is under pressure because of the rising dollar, and that's going to bring this number down. So you check back in a week, this is going to be red too. So it's all going to be red. And it's going to get redder. Okay? That's my opinion. It's going to get redder. But the thing about this is we can see what happens. That's why I love this trading. I can have my opinion, other people can have their opinion, but the numbers don't lie. Okay? So there's nowhere to run in a global downturn, in terms of traditional investing strategy where you try to be bullish somewhere else in the world. There's nowhere to do that. Okay, Europe. Various places in Europe. The best place is Israel for now, and Finland. They're gonna get destroyed like everybody else. That's the 3 month. And the month on the 1 month on a monthly basis, they're all down too. So as time goes on, this 3 month change, the 3 month level will be red. The 6 month level will be red, and all of the gains from 2017 will be red. It's all going to go negative. The Americas, whole month gone. Percentage change for the month is gone. And over the last 3 months, the highest one you see here is 6.69 in Brazil. We talked about that earlier. It's going to check back on this. It's all going to turn red. And people are told diversify around the world. Okay. Well, what diversification does, this is all my opinion, it can reduce your losses. It ain't going to eliminate them. Asia Pacific, 1 month percentage gain. Red, gone. 3 months, reducing. South Africa, as gold finishes its decline, South Africa, it's going to get red. It's going to go red. We'll see it. Just keep your eye on it. Moving on down the line. This video is kind of long. I'm going to try to speed it up here. The biggest company in the S&P 500 in terms of the biggest premium paid for S&P 500 company, I'm talking S&P ratio, is Baker Hughes. This is an oil equipment company. And it says here, PE, the closing price divided by the earnings per share based on the last trailing 12 months of earnings. Okay, fine. The dollar is rising. Oil is falling. This company, people are paying 576 times earnings to get a share of this company. It's coming down. All these high PE stock companies are coming down. Watch them. And fundamental traders are told, just hold on. Yeah, okay. Okay. Consumer discretion. This is Advanced Auto, Amazon.com, AutoZone, places like that. They're going to suffer too. Advertising that all these companies and the Fortune 500 companies, as they decline, as their stock price declines, their company, their as these prices go down, that's indicating that the economy is slowing down too. When the economy slows down, you get layoffs, and you also get less advertising on television. Where I'm working to is it's going to affect the rates, ad rates, even on that YouTubers get. So I was just throwing that in there as an aside. This pressure is coming from everywhere. Everybody's going to feel this. Now, barcharts.com also breaks out the top 100 stocks. And so what they do in the top 100, they get, irrespective of industry or sector, they just tell you which is the top 100. Now, they also tell you the bottom 100. Let me see something. I want to go by performance. Okay. Year to date. I sorted by year to date. Gives you an idea of what's you see a lot of biotech, bio. The company that made the most money from not company, I'm sorry. The industry, the best performing industry in that run from 2009 to now was actually healthcare biotech. That's where the money went as an industry. But they're going to suffer too. Again, let's look at the bottom 100 companies. So you got some shippers down here, some oil companies. You kind of get seeing the trend over and over, shipping and oil. And some of these companies were in good industries, like you're looking at this farmer's pharmaceutical company. If pharmaceuticals ran up and for the last 8-9 years, you got to wonder, why didn't this one participate? This is another reason why I don't like picking individual companies, because you can pick an individual company, you can pick this one, you be in the wrong one. But I'll buy the entire industry via an ETF, and I'll get the gain of the whole industry. Okay. um let's see, try to speed this up and close this out, but the good stuff is coming. Okay. I weighted by alpha. Alpha is telling you basically how sensitive the stock is to movement in relative to like the S&P. Like, so if the market goes up, uh, this one will move down at a greater rate. A high alpha means that its movement is greater relative to like the main index. Okay, a measure of how much a stock has risen or fallen over a 1 year period with a higher weighting for recent price activity. So, in that nice run up over the last year, this company, Diana Container Ships, didn't participate. It did the worst. Now, as we move from worst to first, you gotta look at this. This is another shipper. Now, I'll get in what the way. Here's my company, Dry Ships. That's my company. So you know about what container ships are. So that's what I'm looking at. My investment plan that I'm aiming for is I'm charting the decline of oil and the rise of dollar and the movement of the dollar. I believe that we are near the end of that oil decline. We're not there yet. That's going to be the biggest opportunity that in a long time. You're going to be able to buy major oil companies and shipping companies and gold companies. These are real companies, with lots of money in reserve. And you're going to be able to buy them like they're penny stocks. Okay, but with all this talk about what Trump tweeted, how bad cryptocurrencies are falling, what's going on in the major markets, nobody's telling you that, hey, keep your eye on oil and oil related things and gold related things. There will come a time to buy it. This will be the buying opportunity of the century. Okay, so who is making the money? These daggone VIX companies, these volatility index. So far, these are the only things that are really making the money. Hold on. I'm trying to get to performance by percent change. Yeah. Okay. Actually, it's, yeah, it's the short ones. Let me take the long off, take them out the list. Now this changes change percent for today. This gives you an idea who's making money as this market is going down. This is a biotech bear market ETF. It's up 11% today. This is a bet that the biotech, which was number one, is going to fall, and it is, because all those things are at a premium, and we're in a global downturn. Natural gas, as I said, the dollar is getting stronger. That's forcing energy to go down. But I believe that energy is not going to keep falling. It's way too high right now to take a chance and buy it. It's got to go down a lot. Okay? But there will come a time soon, maybe by spring, that energy will be ready to rise, and the rest of the market, I believe, will still be falling. I believe that energy, and here you go, and oil. See, these are bets that those things will fall, and that bet is paying off because the dollar is getting stronger. Okay, so how you make money right now? I'm telling my family, first of all, to get out. But if they insist, if they really and truly insist on getting having some type of investment, what I say to them is invest in this VIX. Again, this was a long bet. The VIX is a bet against the market. So when the market was rising, betting against the market was the losing proposition. But when the market turned around, I'm sorry, when the market started declining, the VIX was uh, the best game in town. So for those people that insist on, like, how do I make money right now? This is where I tell them to go. I tell them to go to VXX. I try to give them an exact symbol. You want uh, one of these volatility indicators. You don't want to be in one of those bearish volatility indicators. The one that where people lost 93% of their money, that was a bearish volatility indicator. They were betting against this. They were betting that this long decline would continue, and they were wrong, and it reversed. So you would be getting in near the bottom of this long decline. Now you see right here, I'm trying to put the arrow on the price peak. It's like 115,000, some crazy figure. Will it get all the way back up there? I don't know. It depends on how far this market falls. But right now it's 53. Now, this is very risky. If you want to, I tell my family that want to avoid risk, get out the market altogether. I'm not saying pull your money out your retirement account. You can leave it in the account, in a money market account. That's what I tell them. You don't have to invest it in anything. It could just be seated there, and it'll be in a money market account. Once you sell out of the fund you're in, it'll just still be in the account, but it won't be allocated to any particular thing. That's what I tell my family to do. My family and closest friends. Well, the ones that they just insist on having some kind of a role in the market, I tell them to put a small amount here. That's if they really got to be in it. Now, there's a mutual fund here that does the same thing basically. But I would rather do an ETF. The problem with the mutual fund is you can't get out of it or into it during the middle of the day. You buy it at the end of you can go on the computer at any time and enter an order to buy it, but they won't execute that buy until 4 p.m. You can go on your computer at any time of the day and say you want to sell it, but they don't execute that sell signal until 4 p.m. The ETF, they sell that immediately. But another symbol that I like, eh, probably as much as the VIX, is this one, small cap bear. So remember I told you that those small companies don't have the money, and small cap companies, people don't feel that they can trust being in them in tough economic times because they don't have the money in reserves to see them through tough days. Well, this symbol, TZA, it's a bet against these small cap companies. Now you'll see over the trend, it's just like the volatility indicator. The volatility indicator is a bet against the S&P 500. This one, TZA, is a bet of the the smallest companies. See, the S&P 500 is the 500 largest companies. This one is, I would say, it's like the 2,000 smallest companies. And so this one, you're betting that these small companies are not going to be able to survive these tough times. And this is the move that they've made since late January when the market started to decline. The market started to decline around here, and this small cap took off. And these are going to run for a while. So unfortunately, we're at a point in time where the safest position is A, on the sideline, or in one of these bear market ETFs, either the volatility index that's betting against the S&P 500, like one I just showed you, or this small cap bear, which is TZA. Now you can come to this site and click around and see for yourself. Again, call up your financial advisor, your at your retirement account and at your bank, and tell them that you are interested in that you want to discuss with them the risk associated with investing in a bear market fund. And if you ask them, it would be interesting to see what they would say. What's riskier, staying as you are or getting in a bear market fund? If they told me that I'd be better off just staying as I am, holding my long position as the market declined, if they said that that decision was more reasonable than getting in a bear market fund, I would never talk to them again. Okay? But no matter what, you have to learn to read the charts. You got to go over that basic stuff that I told you about how to read the charts. Okay? So this is not something you're going to be jumping in and out of. You're going to hold this. You're going to hold it. You're going to hold it for a while. For a while, we in Elliott wave theory, we go down in an ABC pattern. We're nowhere near the end of the A part of the wave, so we have a significant amount down to go. Okay, so I would be talk to your financial people, see what they say. If you find any value in what I've had to say, please like the video. Please comment. Please subscribe. Please tell other people. This is the time to get your family on their eyes on what's going on. Because we have a lot. If you have people in your family that are 50 and 60 years old or more or older, you need to make sure that they know to pay attention to what's going on in these markets. Because a 60-year-old or 50-year-old person, they will not be able to retire. After the destruction that we're going through right now, they think that they are going to retire because they remember the last balance they saw in their on their retirement statement. Well, when they get that statement in March, it's going to show severe destruction. And if they don't do anything and they hold on like the people on TV are telling them to do, they will work until the day they die. They will never retire. That's all I got. This is Dollar Will.